show this week, it's interviews you can use. And on today's show, Lifestyle Solution Writers. And with me today is Joe Ross, CLU CHFC. Hi everyone, I'm Steve Savant, syndicated financial columnist and contributing author to Backroom Technician. Let's get down to business. Well, welcome to the show, Joe.
Thank you, Steve. It's good to be here.
Well, I have to say, I'm always into doing interviews with carriers who are doing anomalous issues, distinctive things, and I have to tell you, I'm in love right now with a really good idea, and I see many applications. I'm going to try to confine myself to the basics for today. Let's walk through the basic idea of why you thought this was such a hot consumer idea, which I do as well. Walk me through the first rider and kind of introduce us into that kind of idea. Why did we go this far with American General?
Well, the exciting part, Steve, is that we're kind of capitalizing on a change in the consumer buying awareness of life insurance products. There's been a massive trend evolving around buying life insurance, not just because it provides death benefit if you need to pay off your mortgage or send your kids to school, but it also is now providing a liquid pool of money that retirees can use in post-retirement in a way they've never used before. And it's dramatically changing the way life insurance is sold, and it's dramatically changing the way people like to use their life insurance products along the way. So when we take a look at this first rider, which we call the Lifestyle Income Solution Rider, it's designed to allow you to accelerate the death benefit. And I know a lot of people have heard about things like that before with these long-term care and chronic illness riders, but this is different. This is unique. This is really aimed at a couple of statistics in recent surveys. One was that 61% of retirees recently surveyed said that they fear running out of money more than they fear death itself. And the other statistic that was interesting is that they said over 50% of those people surveyed have done no planning for that contingency. Well, that's interesting because now they're running scared. They've brought some debt into retirement they didn't expect to bring. They're worried about interest rates, stock market corrections, they're worried about Social Security, they're worried about rising taxes, and the fact that they simply haven't saved enough money. And so this rider is designed so that if you add the rider to the contract and pay the premiums in a way so that by the time you reach age 85, the premiums will guarantee that policy to age 100, that policy owner has carte blanche access to that death benefit simply because they achieved age 85. Allowing them to access up to 10% per year of that death benefit for up to 10 years. A $300,000 death benefit, you can have $30,000 a year for 10 years. $1 million death benefit, you can have $100,000 a year of your death benefit every year for 10 years.
Now, there's no triggering event to this or anything. It's just when he hits that age, or she hits that age, that triggers 10% of whatever the death benefit is.
That's exactly right. It's no holds barred. There are no strings attached, no constraints. You simply achieve age 85 and you can start drawing down that death benefit.
Okay, can I repeat to make sure I understand? So
yes.
on our retirement timeline, maybe we burned through our qualified plans.
Yeah.
Maybe Social Security isn't adequate because it was paired up with our qualified plans. Now I'm sitting about 85, somewhere around, that might be a life expectancy for some.
Yes.
I look at that and I say, I really need the income now. I'm going to go ahead and trigger this. Now, what are the tax issues with that?
Okay, great question. The tax situation on this particular distribution is exactly like you'd see on an ordinary cash distribution from a life insurance policy. It's treated on a FIFO basis, so it'll be tax-free up until you receive your cost basis, and then a 1099 is ordinary income thereafter.
Well, I think, and so if there's a difference, if it is possible for the client to actually burn through all 100% of the death benefit, is that correct?
That is correct. They can
so he
use
could have
the
gotten
entire
it
amount.
front.
That's correct. And so it's really under that category of life insurance for the living. It's now a new era where the people who used to buy life insurance and figured at age 65 they don't need it anymore, suddenly a new dawn has arisen where they realize there is a purpose in long-term permanent life insurance out to ages beyond your retirement.
I'm fantasizing. I think this could actually wreak havoc with the life settlement market because why would you surrender your contract for 25% at max probably when I'm sitting there, when I have 10% every year amortized for the next 10 years when I probably need it most?
It's an interesting point because you could do a number of things. You could withdraw enough of the death benefit to reimburse you for your premiums, so essentially you had free life insurance. You could use it as a substitute for what could have otherwise been an expensive life settlement process to have carte blanche access to your death benefit. So it changes the game in a way that life insurance agents and life insurance buyers no longer buy term insurance just for the short-term life insurance, and they don't incorrectly use term insurance for long-term needs. They'll now buy permanent life insurance knowing that they can either get all their money back or dive into that cash the death benefit to be able to supplement their retirement income assets to keep them afloat in the later years of retirement.
Now, this is an add-on rider to the policy, right?
That is correct. There is an additional charge
and
for
what
the rider.
products is that, can you place that rider on?
Currently, that product is available on all of the chassis we have that have a lifetime guarantee on them. And we have one of those in our ordinary GUL. We also have an indexed and a VUL contract, all of which have the availability of this rider.
What's that cost, do you think? What we're looking at that, what does that look like?
Generally speaking, to buy that rider, the premium uptick is about a 15 to 20% additional premium. But you think to yourself, if you were an agent advising a client that had a $500,000 life insurance policy who now reaches age 85 and realizes they're running out of cash, would you want to be the agent that could tell their client, sorry, you're out of luck? Or would you like to be the agent that says, well, I have access to another $500,000 you can get at the rate of $50,000 a year to supplement your retirement? Well,
I love that, and I'm even kind of fantasizing about the guaranteed universal life aspect of that. I mean, I'm thinking, hey, you know, usually we have no cash on it. How are those premiums if I was comparing it with and without it? Did you say it's about a 20% difference?
About a 15 to 20% increase in premium to add that rider, and for that you get access to that entire liquid pool of death benefit.
So you have to really think in your mind, if I'm good with coverage to 100, if I'm hearing you correctly.
Correct.
I'm good to 100, and I have now access. So I'm going to have just about the time when we look at projections on Insmark's Wealthy and Wise, a perfect example of this. I look at the projections all the time, and if people are completely into usually 401ks, I'll look at that number and I'll go, that's going to be gone before they're 85.
That's right. And so this becomes the safety net.
So this is the safety net. I think this is a huge, huge new way of looking at it, Joe. I think this is great, and I don't know right now of any other carrier that's offering what you're talking about.
That's right. Up to $3 million of death benefit, $300,000 a year, that's quite a benefit.
It is. When we come back from the break, we're going to address the accelerated access rider, which is really your chronic illness rider. And if you want more information on these riders, just contact me on my email address, and we'll provide at the end of the show. And don't forget to sign up for your 30-day free trial offer for Backroom Technician. Just go out to their site, brtnow.com/trialsignup.aspx. We'll be right back after the break. Back in the day, life insurance professionals were called field underwriters. Then, carriers trained their field force in the basics of life insurance underwriting. Today, the insurance industry doesn't educate the agent population as they once did. But now you can have the Informed Risk Guide at your fingertips so you can illustrate a reasonable rate class for your life insurance prospects. Just request your copy of the Informed Risk Guide at downtobusiness.ashbrokerage.com. It's free from Ash Brokerage, the practice enhancement company. Well, welcome back. I'm Steve Savant with Joe Ross, and remember, you can watch all our episodes of Let's Get Down to Business, including my weekly consumer show, Steve Savant's Money, the name of the game, right out at ashbrokerage.com. Just click on the show logo, and it'll take you right out to the home page. And we're talking about the accelerated access rider, a chronic illness rider. But before I get into that, just a heads up, before moving forward with any of the ideas on our show, always consult your tax advisor or legal counsel, as well as your broker-dealer compliance officer. Well, let's get down to business. We're talking about this new rider.
That's right. We have added some innovation to this chronic illness rider to do some things that we're not seeing anywhere else in the industry. You get to make two choices with the chronic illness rider from AIG. The first choice you get to make is how much of the death benefit do you want to make available to yourself? So for example, with many of the contracts today, if you bought $1 million death benefit, you're required to accelerate the $1 million. With the AIG contract, you can select anywhere in the range from 50% up to 100% of the death benefit. So if you wanted $1 million contract, but you thought there's no way you'd ever need $1 million worth of chronic illness care support, you could dial that back to $1 million policy with $500,000 of chronic care coverage, and of course that'll reduce your premium. So that's decision one, is how much of your chronic illness benefit do you want relative to your total death benefit. The second decision that you get to make, which is really an innovation for AIG, is how much of that benefit do you want to have available to you every month? Many of the contracts out there leave you very constrained. You can buy a death benefit and you can have up to X% of that death benefit, and there are no real flexibilities built in. With the American General contract, once you've made the selection as to how much of the death benefit you want in the aggregate to be accelerated for chronic illness care, the second choice you get to make is how much per month, and you're not confined with just one particular percentage. You can choose a 2% per month, 4% per month, or a really innovative change. We've added a third option called a pure per diem. So as you know, in the indemnity style of chronic illness benefits, where we don't require any receipts for reimbursements, we just pay the amount out, but we have to stay underneath the IRS regulations for the per diem. In 2014, that's going to be about $9,900 per month. Now, in a lot of these contracts, they won't allow you to buy more than a $9,900 benefit. And if you become confined to a nursing home 15 years down the road, when the per diem has now raised through inflation to $16,000 a month, you still get $9,900. So this third option with AIG is truly innovative, where you can simply select a per diem option, and whatever the government per diem rate is at the time that you go on claim is the amount of benefit you get every month until the sooner of two things happen. Either you expire or the entire amount of benefit you've selected has been used up in the aggregate. That gives you a built-in form of inflation protection directly tied to the IRS and the government's scaling of that per diem benefit year after year.
Now, what's the cost on something like that? Because that now you're talking about tracking and tying it back to the government's rate.
Well, that's a great question, and we're going to be able to dovetail right into some of the closing thoughts that I had on the whole deal. The first part is there's about a 12 to 15% premium for that capability. But what's interesting about this is that if you had both of these riders to the same contract, we know that we can't accelerate the death benefit twice. There's overlap on benefit that can be accelerated. So there's a built-in discounting when you apply for both of the riders at the same time. So it's interesting to see, when we looked at the competitive comparisons, the chronic illness rider is very competitive with everything we're seeing in the marketplace. We can actually add the two riders together and still barely be outside the cost of what you're seeing in many carriers for just chronic illness. And now if you, as we like to say, prior to retirement, you're looking at three big risks, right? You're looking at putting your kids through college, paying off your mortgage, and replacing your lost income. Once you retire, there's three new risks, three new things that can happen. You can die too soon, you can live too long, or you can get sick along the way. And the combination of these two riders, Steve, is remarkably good at giving you an entirely new value package where if you die too soon, the death benefit will take care of your heirs and survivors. If you live too long, you can benefit as the policy owner and the insured from that death benefit to accelerate it beyond age 85. And if you get sick along the way, we can distribute the money for that either on the 2%, 4%, or per diem payout benefit. And so it creates a new multifaceted financial vehicle that gives consumers today a new level of confidence, security, and liquidity in their life insurance that really does change the way they look at life insurance and the way they want to use it as they go forward into their retirement.
When I hear you talk about this now, have you seen how our agents, how our registered reps, and people that really sell this for a living, how are they doing the one over the other? Are they doing the combination? What have you seen thus far?
Well, the way we're going to package this up is that you're going to have one of two choices with the product. You can either buy the chronic illness rider by itself, or if you want that acceleration at age 85, that lifestyle income solution, you can only have that if it's bundled with this because the pricing is so impactful when you bundle the two together. So that's the only choice you make. And generally speaking, what we're anticipating is the vast majority of people will offer this product with both riders so that no matter what contingency the client runs into, dying too soon, living too long, or getting sick along the way, the product is there to support them financially and give their family a sense of security that protects literally their retirement portfolio so that they don't have to drain their 401k in order to pay for these other expenses.
Any underwriting issues with this?
The chronic illness portion has a supplemental application, and it is underwritten like a long-term care product would be with the typical kinds of things that you'd see. There is no additional underwriting for this age 85 acceleration capability under the lifestyle.
So conventional underwriting for the death benefit and morbidity underwriting for the chronic.
That is correct.
Okay. Now, when I'm looking at this, and I'd love to see some illustrations. You know, I know that you guys are just rolling this out.
That's right.
Fairly new, right?
It's coming out right now, yes.
So when we see illustrations on this, and we'll be back, I'm going to give you all these illustrations, so we'll put it out there and start saying, hey, this is the number. I think this is innovative. I think it's edgy, and I love the accelerated death benefit, 10% every year. That is a huge savings for the back door of your retirement. Well, that's our show for today. Don't forget, you can read my online insurance news commentary, advisor blogs, and articles on Producers Web, as well as my answers to consumer questions on the Insurance Library. And you can view all our past episodes at downtobusiness.ashbrokerage.com. So follow me on Twitter, Facebook, and LinkedIn, or just email steve.savant@ashbrokerage.com. And remember, you could be wiser as an Ash Brokerage advisor. I'm Steve Savant for Joe Ross.